Hey, welcome everyone. Tom here from Park Avenue Trading, your chief trader, keeping you sane in insane markets and offering you some trading advice and techniques so that you can advance your trading. So without further ado, let's get into our next video. We're going to be using Fibonacci as a means of determining market structure. So just to go over, the sequence of Fibonacci is 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144 to infinity, right? So we know the sequence, right? If you don't know the sequence, you could easily Google it, look it up. I mean, it's everywhere, Investopedia, everything. So now we know that dividing one number by the next after the eighth sequence would yield 21/34 or 0.618. And where that figure came from, or the importance of that figure, according to Leonardo di Pisa, was, or Leonardo or Fibonacci, was the relationship of the Great Pyramid height to its base. He studied the pyramids of Giza, and he came up with not only using the pyramid of Giza, basically as a mathematician, he was actually looking also at the reproduction rates of rabbits. So it was a very strange way that he came upon this sequence. Now, of course, it is, you know, the 0.618, the golden mean is rampant in nature. We could get into esoteric talk about, you know, how, you know, the human genome and the DNA sequence and everything is related to this. But, you know, for our purposes, we're just trying to get a leg up on the marketplace, right? So we won't really get too deep into that. But what we can do basically in this video, going over how we can determine market structure with Fibonacci, we're going to use the 21 bar sequence. Now, I am going to be doing a Fibonacci wave count, and I'm going to be covering that in the course because it's really in depth, and like you need to build upon it brick by brick. And you know, I'm going to go over a Fibonacci wave count. It's kind of like Elliott wave, but it has defined points. But this would be the beginning of it. So let's take this video as like a thought experiment, okay? Just something that you can use on the weekend. Say, hey, this guy's saying that we're going to determine a market structure using a 21 bar count. Now remember, we also have 34, 55, 89, 144, and so on. But really 21 was the one that intrigued me the most. Why? Well, if you're familiar with who the turtle traders, Richard Dennis and Bill Eckert basically had a trading system back in the late 70s, early 80s, where they were using a 20-day bar, a 20-day bar high, a 20-day bar low to enter the marketplace. Very simple technique. Basically, if the market went up higher than the last 20 bars, they would buy it, and they'd have a money management stop on it. And if it went lower than the last 20 bars, they would sell it. And that was their system. And it failed 70% of the time, but when it did work, it worked really well. So it was a game of numbers. You know, it was basically just risk reward, and they also had a 55 bar emergency. So if they missed the 20 bar, they would get in at 55, and they had all these rules. Basically, the previous breakout had to fail in order for them to take the most recent breakout. But I digress. So we're talking about, you know, the turtle trading system, and it's still, you could read about that also. I mean, I think there's books written about it, and some people still use it today. It really works very, very well in a very strongly trending marketplace. But you get chopped up if the marketplace is in a consolidation or a big rectangle like we've been in, say, sterling dollar and euro dollar for the past month, 2 months, 3 months. Really, we haven't done anything, but the crosses have been flying around. So, but I digress. Let me just stay to the topic. I'm sorry, I don't mean to get off the topic, but let me get my cigar going. I'll come right back. Okay, got the cigar and the espresso. So what we're just going to introduce you to, like I said, this is, if I haven't said it, I might have said it. This is like basically a thought experiment. And we're going to use the Fibonacci count or the sequence to basically determine what the market structure is saying. So we're going to use 21 bars. And remember, the sequence goes from 8, 13, 21, 34, 55, 89, 144, and so on. Okay, but I'm only interested in 21 because I basically took the idea from, like I said, Richard Dennis's group of the turtles. So if we're looking at this marketplace and we're saying, okay, where are we? You know, like, where's the next move of significance going to occur? Well, what we have to do is we're going to look at market structure. And market structure basically says when we have a high, then we have a low, and then we have a lower high, and then we have a deeper low, then we have a lower high, and then a deeper low. Then that deeper low is the point of the break of the structure of getting out of the big rectangle and into, you know, a downward movement. Okay, so like, for instance, if we were looking at structure itself, we got the high, we got a low, we got a lower high, we have a higher low right here, doesn't count. Okay, we got another one that's kind of still a little bit higher right there, doesn't count. So hang on a second here, let me get out of drawing mode. All right, I get out of drawing mode. And there it is, exit drawing mode right up in the corner. And then we get a deeper low right here. This is the point. So we had the high, we had the low, we had a lower high, we had a lower low, right? We got a lower high, we got the deeper low. This would be the point, okay? This would be the break point for the market right there. So in other words, market structure is saying that if it breaks that low, it's going lower, it's turning down. It's also saying that this is the pivotal point high up here. If we get through that high, most likely that's going to be the next level that's going to catapult the marketplace upward, right? So let's just use, and like I said, this is just a thought experiment. It's something for you guys to do and gals to do. And this is Swiss, this is sterling Swiss. It's not something I trade. So I always go to charts that I'm not very familiar with, so I don't have any bias to. I'm just trying to apply my ideas to the market. So if I take this peak, for instance, and I go, okay, let me measure from this peak 21 bars out. That's 21 bars out. What I have, I'll take the lowest low of that area, of that 21 bar sequence, and say that's an important point for structure. Okay, that's a very important point. So what I would do now, it's easy to see, right? Because the chart's in front of us. So we could say, oh yeah, well, we knew that it was going to go up a little bit and go down. We didn't know anything. All we knew was that this point right now is an important point. It's just 21 bars away, 21 days away from what this top was. This is a daily chart. Okay, so it was 21 days away. So that low was an important, well, it could be an important low. So that would be an interesting point to basically now say that we could run fib levels for retracement and basically say, okay, we're going to use those 2 points because they're 21 bars away, a Fibonacci number, and we're going to apply retracements and or levels to basically get short at or long at, or whatever you're going to do. Okay, this is not about making money off of a dead chart. It's not. It's basically just trying to give you an idea that you could use 21 bars. Now if you wanted to, you could go, well, I don't want to use 21 bars, I want to use 34 bars, I want to use 55 bars, I want to use 89 bars. You can, but play with the sequence to see what you come up with. It's just an interesting thought experiment for you to determine, like, hey, that's a good low. That low, because it's 21 bars away, is a really significant low point. Now you could also look at this chart and go, look at this low here. It's slightly lower. Okay, that's market skid. All right, now the market does it again right here. It comes down lower, kind of like a skid, but notice this is a daily chart. It does not close below this point. It basically has a reversal up through it, basically saying, nope, not going to happen today. And that's the point. This point right here, this low that's created right here, is the market structure point. So this is the structure point where we'd say if the marketplace breaks this, it's going lower. Okay, now if it gets through this top, let's put a line there just so we know where the top is. The market structure saying it's going back into a potential, let's put a ray, breakout, right? Everybody's interested in breakouts, right? So like up here, I guess that's good enough. What's the top, just so we get it right? I hate when things are wrong. 115.45. So I got to do this. 115. Yeah, it's the same thing. It's fine. 115.45. 115.45 up here. That's the point right there. Okay, so let's just move forward. So it never gets above this. Okay, and now we have the pivot down here too. That's the important pivot. So now I'm just using the last off that last structure, the 21 bar high, 21 bar low, right? So here it is, and there it goes. Now it broke. Okay, so now the marketplace basically moved lower down to the low. So all right, so we used this point to this point here. Okay, now guess what we can do? Well, we can consistently move from point to point to get the structure, to stay ahead of the structure. So if I go from here, 21 bars right here, that's now the new important point. This point, the price has come down lower. And as we can see, we don't ever really pass that until we actually just spike it here and then come back down off of it. But constantly moving 21 bars. So from here, we found this high. So we're going to go 21 bars right here. Where's the lowest point? Right there. Well, we found that one already. So let's go from this pivot low. $21 bars right there. That's the high point right there. Okay. Now if we move 42, that low becomes important. So we're just using 21 bars and we're just moving forward. That's it. And so what I want you to do is I want you to do a thought experiment and start messing around with it. Like, okay, so I got a high point. Let me go 21 days forward. What's the lowest point I got? That's my important market structure point. That's the point that I want to start using to see what happens at that point. So it's a point that you could use forward in time to say, like, okay, that low was an important low. Is the marketplace blowing through that low? Is it breaking through that low? No, it doesn't. It holds, it goes up. Now we could start using retracement levels. So in the next video, we'll take it a little bit further. We'll go retracement level, and then, you know, where the 21 bar high is against the low, and then we could use our retracements, and we could figure out where we could take, you know, low risk, high reward trades. I hope you find it interesting. I mean, I wanted to bring it to you because the sequence itself can be used in many different ways, and this is just one of the ways that you could apply it to give you an idea of what, you know, the marketplace is whispering in the ear. And remember, always enjoy the party, but dance near the door. I'll see you on the next video. I hope you enjoy this one. If you like it, give me a thumbs up. Write some comments. Tell me what you want to see. And I look forward to seeing you in the next video. Cheers.